So imagine you want to buy a new car.
Right.
Okay. But you go to the dealership, the guy looks you dead in the eye and tells you that you can't actually have a car until like 2033.
Oh, wow. Yeah, that's a problem.
Right. So what do? You don't just stop driving. You fix up your old car, you drive it for way longer than you ever planned, and you end up paying this massive premium to whoever owns the spare parts.
Which is incredibly expensive.
Exactly. Now, take that exact nightmare scenario, but instead of a $50,000 car, it's a $150 million commercial jet.
Right.
Because today, we are doing a deep dive into a single, incredibly dense financial document. We are looking at AerCap Holdings NV's Q2 2026 earnings report.
And this report is it's a gold mine.
It really is. Our mission for you listening today is to decode exactly how the world's largest aviation lessor is taking this global aircraft supply chain crisis and just, turning it into billions of dollars in profit.
It's honestly a phenomenal case study in market dynamics. I mean, we're looking at a company sitting right at the center of an industry-wide bottleneck, and the numbers they just released reflect that position perfectly.
Yeah, let's just put those headline numbers right on the table before we do anything else. So for the second quarter of 2026, AerCap posted $2.167 billion in total revenues.
Which is a massive 15% jump.
Huge jump. And their adjusted net income hit $811 million. That translates to $5.14 per share. But here is the real kicker for anyone reading this report. Management just raised their full-year 2026 adjusted EPS guidance to 16.80.
Yeah, that's the number that really jumps out.
Right. And for anyone listening who maybe doesn't stare at earnings reports all day, EPS is just earnings per share. And guidance is management's official forecast of how much profit they expect to make for every single share by year-end.
Right. So raising that number mid-year is essentially management planting a flag. They're telling the market, look, we are making money way faster than even we predicted.
Yeah.
And, what's fascinating here is that when you read CEO Angus Kelly's commentary throughout this document, he makes it very clear that this isn't some temporary spike. It's not an accounting fluke.
Not at all.
These results are the direct, unavoidable consequence of two unstoppable forces colliding. On one side, you have this sustained, relentless demand for air travel. I mean, the public wants to fly, and airlines are just desperate to sell them tickets.
Everyone is traveling right now.
Right. But then on the other side, you have severe, ongoing aircraft supply constraints. Boeing and Airbus, they just simply cannot get new planes off the manufacturing lines fast enough.
They're completely bottlenecked.
Completely. And AerCap is positioned right at the absolute epicenter of that collision.
So to really understand how they're, monetizing that collision, we have to look at how AerCap actually collects its cash day to day. We need to view their business model as essentially an airborne landlord.
I like that. Airborne landlord.
Right. Because when you read through the income statement, their basic lease rents, so the monthly checks airlines just to have the planes, they're huge, but they are relatively stable. They brought in $1.67 billion in basic lease rents, which is up just 1% year over year.
Just 1%, right.
But then you drop one line down in the source, and there is this glaring anomaly. Maintenance rents and other receipts rocketed up 54% to $177 million.
Yeah, that is a huge leap.
So, okay, let's unpack this. Leasing planes sounds like being a landlord for an apartment, right? You just collect a fixed rent every month.
That's the basic idea.
But wait, why is maintenance revenue up 54%? Are the planes suddenly breaking down more often?
Well, no, it's not that they're breaking down more, but that 54% jump is actually the single best indicator of the supply constraint in action.
Really? How so?
It requires a quick detour into how aircraft leasing actually works mechanically. When an airline leases a plane from AerCap, they don't just pay that fixed monthly rent. Because, airplanes are incredibly complex machines and parts constantly wear out. So the airline is also required to pay what are called maintenance reserves.
Okay, so it's like a security deposit.
Well, it's a bit more dynamic than a security deposit. Think of it more like a usage fee.
Cool.
The airline actually pays AerCap an hourly rate for every single hour that jet engine runs. And there's a per cycle fee for every single time the landing gear drops and hits the tarmac.
Oh, wow. I had no idea it was that granular.
Oh, very granular. It is a dedicated pot of money being built up continuously to pay for the inevitable, mandatory, heavy maintenance checks that every plane has to undergo by law.
I see. So it's literally getting paid continuously based on how hard you drive the rental car.
That's a great way to think about it. Now, under normal circumstances, airlines want to fly newer, more fuel-efficient planes.
Sure, saves on gas.
Exactly. But right now, because of those massive delivery backlogs at the manufacturers, airlines can't get the new planes they ordered.
So they're stuck.
They're totally stuck. So what is their only alternative? They are forced to fly their older, currently leased planes for much, much longer than they originally modeled.
Right, which goes back to the car analogy.
Exactly. The report actually notes that AerCap's owned passenger fleet has an average age of 7.4 years. But when you split that apart, it gets interesting.
What's the split?
Their current technology aircraft, which is the industry term for the older generation, have an average age of 15.6 years, while their new technology planes average just 5.5 years.
So they have this barbell effect going on, a chunk of very new planes
Yeah.
and a whole separate chunk of planes pushing 15 or 16 years old.
Precisely. And that older chunk is the key to the 54% jump. Older planes require significantly more heavy maintenance.
Of course.
So when leases are extended because an airline is desperate for capacity, or when those older planes finally hit their major maintenance milestones, and the airlines either do the work or return the aircraft, AerCap recognizes those accumulated maintenance reserves as revenue.
Got it. So the bottleneck at the manufacturers is directly forcing airlines to run older metal longer.
Yeah.
And that directly inflates this incredibly high-margin maintenance revenue segment for AerCap.
You nailed it. The delays at Boeing aren't hurting AerCap at all. They're actually pumping up their maintenance revenues.
That is just brilliant. But, squeezing more cash out of existing leases is only part of the story here. The real leverage of this supply-constraint advantage shows up when AerCap actually sells these assets off.
Oh, absolutely. This raises an important question about their broader strategy, because we really have to transition our thinking here from AerCap as a passive landlord to AerCap as an aggressive, active portfolio manager.
Yeah, let's talk about the art of the flip, because I want to bring up the massive Q2 asset sales listed in this report.
The numbers are staggering.
They really are. They sold 38 owned assets in the second quarter for $1.4 billion.
Wow.
And out of that $1.4 billion, they generated a $223 million net gain on sale.
Which is pure profit on the sale.
Right. Now, here's a specific metric from the report that I stumbled over initially, but it's super important. It says this represents an unlevered gain on sale margin of 20%, or 1.7 times book value on an equity basis.
Yeah, that's a mouthful.
Right. So, wait, before we move on, for those of us who don't spend our weekends reading accounting textbooks, what does unlevered actually mean in this context, and what exactly is book value on an equity basis?
It is definitely dense terminology, but the underlying concept is actually quite straightforward. Let's just take unlevered first.
Okay.
In finance, leverage basically refers to debt. So when AerCap says this is an unlevered margin, they're saying, hey, if you strip away all the loans and the mortgages we used to buy this plane and you just look at the pure sale price of the asset versus its cost, we made a 20% profit.
Okay, that makes sense. They want investors to see the raw profitability of the physical plane itself, totally regardless of how it was financed.
Exactly. It's the pure performance of the asset.
Okay. And the book value?
Right. So book value is essentially what the company's accountants say the plane is worth on paper. In aviation accounting, companies depreciate the value of an aircraft over a set schedule. Usually it's about 25 years, taking it down to a 15% residual value.
So it's just a straight, predictable mathematical line going down every year.
Normally, yes. But right now, the real-world value of a plane does not follow a straight, predictable line. Because airlines are absolutely starving for metal, the actual market value of a midlife aircraft has completely decoupled from its paper depreciation.
Oh, wow.
Yeah. AerCap is selling these planes into a starving market. And that's exactly why they can command a 70% premium over what their own accountants say the plane is theoretically worth.
So it's literally like flipping a used car for 70% more than its Kelley Blue Book value. But they're doing it with fleets of multi-million-dollar jets.
Yes. They are arbitraging the difference between rigid accounting rules and actual market desperation.
It is a remarkable position to be in.
Yeah.
But, the true brilliance of their strategy isn't just that they're making these huge margins on sales. It's what they are choosing to do with that cash.
Because they aren't just hoarding it in a bank account.
No, not at all. And they aren't just using it to pay huge executive bonuses either. They are deploying it aggressively back into their own company.
Right.
The report highlights that they repurchased 4.9 million of their own shares for a total of $691 million just in the second quarter.
That's a massive buyback.
Massive. It brings their total share repurchases to over $1.4 billion for 2026 year to date. Plus, on top of that, they declared a 40-cent per share quarterly dividend.
See, think about the mechanics of the capital allocation happening here. They are selling physical assets, the actual planes, at a massive premium because the market is overvaluing them relative to their paper value.
Right.
Then they take those proceeds and buy back their own equity, their own shares, because they believe the stock market is undervaluing the cash flow that their remaining fleet generates.
That's a brilliant cycle.
Yeah.
By reducing the number of outstanding shares while simultaneously growing their total equity base through these highly profitable sales, they are supercharging the value of every single share that remains.
Exactly.
And the math checks out perfectly. By selling assets at a premium and buying back the stock, they've driven their book value per share up approximately 16% year over year. It landed at $119.21 as of June 30th.
So you shrink the pie, but the pie itself is becoming vastly more valuable.
Exactly. But that naturally leads to a structural concern, right? If they're selling off 38 assets a quarter for these huge gains, they have to replenish the pipeline to stay in business. I mean, you can't just sell all your planes and eventually have no planes left to lease.
Right, you'd run out of inventory. And you've hit on the critical balance of the leasing model. This requires us to look at their CAPEX, or capital expenditures. They have to constantly refill the bucket.
And looking at the source, the numbers here are just as dizzying as the sales.
Oh, yeah?
The report notes that while they sold $1.4 billion in assets, they spent even more on CapEx. They laid out $1.9 billion in the second quarter alone, purchasing 25 aircraft, 5 engines, and 3 helicopters.
So they are definitely refilling the bucket today.
They are. But here's where it gets really interesting. I noticed a very specific post-quarter event tucked into the report.
Oh, the July order.
Yes. In July 2026, they placed an order for 15 Boeing 787 aircraft. But the delivery dates are scheduled from 2030 all the way to 2033.
Right.
Why lock up capital and make commitments now for a plane you won't even see for another 4 to 7 years?
Well, that single detail about the 2030 to 2033 delivery window tells you everything you need to know about how AerCap views the macroeconomic environment. The global order books for Boeing and Airbus are effectively sold out for the remainder of this decade.
Wow. Just entirely sold out.
Entirely. If a major airline wakes up today, realizes they have a capacity shortage, and decides they want to buy a brand new 787 directly from Boeing, they can't.
They just can't get one.
No. They are likely looking at a delivery date well into the 2030s, totally regardless of how much cash they have on hand.
So even a massive, well-funded airline is essentially locked out of the new plane market for the next 5 years.
Exactly the problem. So what lessors like AerCap do is use their enormous balance sheets to secure those production slots years in advance. They buy in bulk.
Right.
This accomplishes 2 strategic goals. First, it secures AerCap's own inventory pipeline, guaranteeing they will have fresh metal to lease out into the next decade.
Yeah, it makes sense.
Second, and far more importantly, it ensures they remain the ultimate gatekeepers of global aviation capacity.
Because if an airline needs a plane in 2030 to fly a new route, and Boeing is sold out, their only option is to go knock on AerCap's door and agree to their lease terms.
Bingo.
It's like buying up all the prime commercial real estate in a city years before a predicted population boom hits. You know that eventually everyone is going to have to rent from you.
It creates an incredible economic moat around their business.
But, buying all that prime real estate, or in this case, committing to billions of dollars in aircraft, requires massive leverage. Which brings us to the balance sheet.
The most critical part.
Right, because they've mastered the math on capital allocation. But these planes cost real money, which means taking on debt. AerCap has $71.1 billion in total assets. And sitting against that is $42.7 billion in debt.
It's a huge number.
It's massive.
Yeah.
In a world of macroeconomic uncertainty and fluctuating interest rates, carrying nearly $43 billion in debt sounds absolutely terrifying for an investor. If rates spike, couldn't that debt just crush them?
Well, if we connect this to the bigger picture of how financial institutions manage risk, it's less terrifying and more a study in structured finance.
Okay, walk me through that.
You don't evaluate a bank just by looking at the raw size of its total deposits, right? You look at the spread, the difference between what they pay for money and what they earn on it.
Right, the margin.
Exactly. AerCap is managing a liability structure that is meticulously designed to support their specific type of long-term assets.
Well, the report certainly paints a picture of tight control over that debt. It states their average cost of debt is only 4.2%.
Which is fantastic.
And their adjusted debt-to-equity ratio actually went down. It improved from 2.11 to 1 at the end of last year to 2.05 to 1 at the end of Q2.
See, that 4.2% average cost of debt is the absolute linchpin of their profitability. They have locked in long-term fixed-rate debt that perfectly aligns with the duration of their long-term leases. The industry calls this matched funding.
Matched funding. Okay, let me make sure I'm getting this. Is this basically like taking out a 30-year fixed-rate mortgage on a rental house and then simultaneously signing your tenant to a 30-year lease?
Yes.
So even if interest rates go crazy tomorrow, your mortgage payment is locked in, and your rental income covers it with a predictable profit margin already built in.
That is an excellent analogy. You immunize yourself against short-term interest rate shocks by matching the lifespan of your debt to the lifespan of your revenue-generating asset.
That makes total sense. And here is a stat from the report that I really need you to explain, because it seems completely counterintuitive to me.
Okay, lay it on me.
Despite having nearly $43 billion in total debt, their interest expense actually dropped. It fell 10% year over year, down to $468 million for the quarter.
Right.
And because of that drop in interest expense, their adjusted net interest margin, which is basically that profit spread we just talked about between their rental income and their debt costs, grew 5% to $1.23 billion.
It's impressive.
But how is a company carrying $43 billion in debt actually dropping their interest expenses in this kind of environment?
It comes down to active liability management and understanding what are called tranches of debt.
Tranches.
Yeah. When a company borrows $43 billion, they don't get it in one giant loan from one bank. They issue bonds and take out various loans over many years. This creates different slices or tranches of debt, each with its own specific interest rate and maturity date.
Okay, so they have some cheap loans from a few years ago and maybe some more expensive loans from recently.
Precisely. Now remember that AerCap generated massive cash flows this quarter. $1.5 billion in operating cash flow, plus those huge premiums from selling 38 aircraft.
Right, the flips.
Exactly. When you have that much cash coming in the door, you can be strategic. As their older, perhaps more expensive tranches of debt mature, they can simply pay them off using their cash reserves instead of refinancing them at today's higher rates. They are deleveraging the balance sheet organically, paying down the expensive slices of the pie, which drives their overall interest expense down.
It's a very elegant financial balancing act on a spreadsheet.
It really is.
But, these planes don't just exist in a spreadsheet. They exist in the real world. And the real world has borders, international laws, sanctions, and wars.
Absolutely.
How does a company with $71 billion in physical, highly mobile assets protect them when a geopolitical crisis hits?
Well, geopolitical risk is the unavoidable reality of global aviation leasing. When you lease aircraft to airlines in dozens of countries, you are inherently exposed to global events and the sudden imposition of international sanctions.
And the report highlights a fascinating detail that illustrates this perfectly. Honestly, it feels more like an international thriller than an earnings report.
The Russia situation.
Yes. During the second quarter, AerCap recognized a $28 million recovery related to the Ukraine conflict.
Wow.
The report specifies this consisted of cash insurance settlement proceeds received from a Russian airline and its Russian insurer in respect of 2 aircraft that were lost in Russia.
It's a stark reminder of the physical risks they manage. When international sanctions hit a few years ago, leasing companies had billions of dollars of aircraft essentially trapped inside Russia overnight.
Right.
The leases were terminated by law, but the physical planes couldn't be flown out.
So they basically had to write them off and turn to the insurance companies.
They did. And what we are seeing now with this $28 million settlement in Q2 2026 is the incredibly long-tail financial cleanup of that geopolitical shock.
It takes years.
Years. But it shows that while the risk of losing physical assets is very real, a lessor of AerCap's size has the legal stamina and the complex insurance mechanisms required to eventually claw back value, even years after the initial event.
It really puts the immense scale and complexity of their operations into perspective. You have to worry about the maintenance reserves on a 15-year-old plane flying in South America, the production schedule of a Boeing factory in 2033, and an international insurance settlement from a Russian airline, all simultaneously.
And management has to synthesize all of those chaotic real-world variables while maintaining that 4.2% cost of debt and delivering an adjusted return on equity of 18%.
It's wild.
It is the definition of operational excellence in a highly volatile industry.
So, okay, we've walked through the complex mechanics of their rents, the
Yeah.
massive premiums on their asset sales, the strategic moat of their long-term fleet orders, and the matched funding of their multi-billion-dollar balance sheet. Let's pull all these threads together.
Let's do it.
AerCap is fundamentally thriving on scarcity. They are capitalizing on high basic lease rents and surging maintenance revenues because older planes are being forced to fly much longer than intended. They are flipping their older assets into a starved market for 70% premiums over book value. They're taking that cash and aggressively buying back their own stock to juice returns, all while expertly managing a mountain of debt by paying down their most expensive tranches.
It's a flawless execution of the model.
So what does this all mean? For you, the retail investor listening to this deep dive, it's a masterclass in how a dominant middleman can turn industry bottlenecks, specifically the airline supply constraints, into pure shareholder value. They aren't suffering from the delays at Boeing and Airbus. They have built a machine to monetize them.
They absolutely have. But as we wrap up this analysis, I want to leave you with a thought that extends beyond just this quarter's earnings and impacts you personally.
Okay.
We talked at length about that July order for Boeing 787s that won't arrive until 2030 to 2033. Think about the broader implications of that timeline.
It's a long way out.
Right. If the world's largest, most sophisticated aviation lessor is betting billions of dollars of their own capital that aircraft shortages and delivery backlogs will persist for the better part of a decade,
Yeah.
how will airlines themselves have to fundamentally change their business models to survive a decade-long squeeze on planes?
Oh, wow.
If lessors like AerCap hold all the cards and control the capacity for the foreseeable future, does the baseline cost of travel inevitably have to skyrocket for you, the passenger?
Man, that is a genuinely chilling thought for anyone trying to budget for a summer vacation in the 2030s. But it's exactly the kind of forward-looking question these dense earnings reports force us to ask if we know how to read them.
Absolutely.
Well, thank you for joining us as we unpacked AerCap's machinery. Make sure to follow the show for daily earnings coverage, stay curious, and keep diving into the numbers.